When startups raise capital, investors don't usually buy standard equity shares. Instead, they invest through structured instruments like CCDs, CCPS, and convertible notes. This is because these instruments balance risk, flexibility, and protection, especially in early stage companies where valuations are still, dicey and can change dramatically. Hi, I'm Preksha from Campus Fund, and in today's video, we'll be talking about the different instruments investors use while they're investing in early stage companies in India. This is a part of our larger series where we are breaking down the different legal jargon that you see in term sheets and other legal paperwork, which is a part of your investment process. So let's start with CCPS, which is Compulsory Convertible Preference Shares. Okay, so now this is the standard and most common instrument used by almost all investors, VC investors in India. Preference here means that investors get priority in certain situations, for instance, during liquidation or dividend distribution, right? Compulsory convertible means that after a defined period, usually within 20 years, these shares must mandatorily convert into equity, right? CCPS essentially provides investors with downside protections, which is essentially recovering their investment first if things go bad or downhill, and upside participation if things go well. CCPs are usually used in priced rounds, which means that the company's valuation is agreed upon by the investor and the company before the investment is done. Next up, we have CCDs or Compulsory Convertible Debentures. So these CCDs are essentially legally considered as debt until they convert into equity. CCDs usually carry an interest component which is nominal, but they must convert within 10 years either to CCPS or to equity at a valuation which is decided at the time of investment, which is also usually at a discount on the next price round, or there is a floor price to the investment that they would be doing. CCDs are commonly used in bridge or interim rounds, or when the deal is very early and the valuation isn't fixed yet between the investors and the company. The advantage for investors here is flexibility, right? They start out as creditors, giving them priority, and they later become shareholders once milestones are met and the company is growing. Then we have something called a convertible note. So convertible notes were introduced by India's DPIIT, which is our Department for Promotion of Industry and Trade, for startups to raise money easily, right? Now these are simple debt instruments that convert to equity in the future, typically during the next qualified funding round. Right? So the law mandates a minimum of 25 lakhs per investor and limits their use to DPIIT registered startups only. So these notes are classified as debt initially and not as CCPS or equity, meaning there is fewer compliance steps and a quicker execution. Right? In some cases, though, key investor protections like information rights, board observer rights, and reserved matters are contractually provided in the debenture documentation even before conversion. So next up, we have equity shares. Now, regular equity shares represent direct ownership in the company. Usually, founders hold these shares. However, these shares also have a lack of protection that investors are usually seeking, right? There's no priority on exit, there is no liquidation preference, and there are no fixed returns. Which is why investors, VC investors typically rarely invest through pure equity except for token amounts to ensure shareholder rights, right? So usually in a transaction document, you will see that an investor is getting X number of CCPS at so and so price and one equity share. This is so that having the equity share opens up shareholder rights for the investor as well. So yeah, now you know the 4 most common forms of instrument used by investors while investing in early stage companies in India, which are CCPS, CCDs, convertible notes, and equity shares. If you have any questions, do let me know in the comments and I'll be happy to answer them. And if you like this video, do subscribe to our channel because in the next video, we'll be talking about both Cs and observer rights.